Government finance and public money. How do government increase money circulation in an economy? How can the government of Kenya increase the money supply or the money circulation, the money that is there, that is spent, that is used around the economy? So most of the money in the economy occurs in the form of bank deposit. So the bank deposit accounts for the huge percentage. So bank increase money circulation whenever they make loan. So if they give you more loan, definitely there will be a lot of money in the economy. So the economy will be liquid. If they give less, then the economy will not be as liquid. And the taking of loan depends on the interest rates. So when the interest rates are high, definitely people will avoid borrowing, and vice versa. So how it works, how the government increases money circulation. So when a bank decides to give a customer a loan, it will credit the account with the agreed amount. From the moment the loan shows up electronically in that customer's account, they'll expect to be able to withdraw it as cash. So the bank must have the cash available in order to be able to hand it over if the customer wants to use the loan to pay money into a different bank account in a different bank. So having, for example, paid for goods with a debit card, the issuing bank must be able to persuade the second bank to accept the transfer of credit money, because the issuing bank is liable to meet demands such as this. So the deposit money that it has credited to the customer's account is seen as liability, as the bank will have to pay the money out. By contrast, the loan is regarded as an asset for the bank, because they'll request it, they'll be paid back in interest. This is because the bank can expect to recoup the money it has issued as a loan, along with the accrued interest. So the money plus the interest, and it has a legal right to enforce the repayment should the customer refuse to pay. So the bank records its transactions using a system of accounting called double entry bookkeeping, which reflects the equal and opposite effects that the issuing of the loan will have on the bank's accounting books. So bank assets and liabilities. So asset is something that is owned that can be used to pay debts. Assets usually produce a return over time. So a bank's most important asset is customer's loan book, since the customer pay interest on the loan that they received from the bank. Liabilities. So liability is an obligation that is legally due to be paid. A bank's major liability are its customers' bank account, since all of its customers expect to be able to withdraw their money at some moment in time. So balancing the books. So banks increase money circulation when they issue a loan in the form of money deposited in a customer's account. Although the loan and its repayment is an asset, the extra account money is a liability, because if the bank fails to make the money available on demand, it could collapse. To prevent from this occurring, maintain tight control of their balance sheet, making sure their liability always matches their assets. They carefully assess customers who apply for loans to ensure they will be able to make repayments. Central bank exists to oversee the whole system and support banks when they face hardships. Setting credit. A balance sheet shows how liabilities are balanced by assets. When a bank makes loan to a customer, the assets to the bank, the amount of the loan is balanced exactly by the liability. Double entry bookkeeping. What is double entry bookkeeping? So in accounting, accountants do this. So this bookkeeping system requires that every business transaction is entered twice. Double entry. It is entered twice. Entered twice in at least 2 accounts to demonstrate that each entry has an equal and opposite effect. In practice, this means that every debt in an account must be matched and offset by a credit. The sum of all debits must therefore be equal to the sum of all credits. Thank you very much.